Hello, everyone. Welcome to RSM's Tax Policy Now. My name is Kyle Brown. I'm a partner in our Washington National Tax Practice. There, I focus on helping business owners navigate the complexities of owning and operating pass-through entities. One question I've seen owners of private companies ask themselves with some frequency since the Tax Cuts and Jobs Act is, am I operating in the right entity structure? Now, for the last 30 years or so, business structure wasn't much of a consideration. From the mid-1980s all the way up until the Tax Cuts and Jobs Act of 2017 introduced changes in the business tax rates, private company owners generally realized a more favorable tax outcome from flow-through entities, S corporations or partnerships, than C corporations. However, after the Tax Cuts and Jobs Act lowered the corporate tax rate, entity choice for private company owners hasn't been so clear-cut. With administration changes and the looming expiration of the Tax Cuts and Jobs Act at the end of 2025, effective structuring requires an understanding and consideration of a number of different things, including owners' priorities, company growth strategies, the effect of potential transactions, and the effect of changing tax laws. For private companies with multiple owners, considering and aligning personal goals with business objectives is critical to effective structuring. Whether it's lifestyle funding or building long-term equity, different priorities may call for different structures. For example, owners focused on cash flow might prefer a flow-through entity, while those prioritizing business growth through reinvestment may find a C corporation to be more beneficial. The company's growth strategy is also a key factor to consider. Rapidly growing companies need to understand their tax structure impacts employee retention, equity plans, and debt management. Partnership might offer tax benefits for equity-based compensation, whereas a C corporation could be advantageous for retaining cash and reducing debt. Significant changes in ownership and business operations, such as estate plan provisions, acquisitions, divestitures, mergers, and new investors, can also affect tax outcomes and warrant re-examination of structural choices. Finally, tax code and regulations thereunder are a long way from static. And while major overhauls are relatively infrequent, the rules do change frequently enough that private company owners may assume some risk if they conclude that structuring decisions made a decade ago still result in the same tax impact to the business and the owners personally. Check out rsmus.com for more insights on business structuring and tax strategies. Thanks for watching Tax Policy Now. We'll see you next time.